You're listening to the Reverse Mortgage Dilemma podcast, where we uncover the financial strategies helping retirees take control of their future. I'm William, your host, and joining me as always is Sophia. We're glad to be back after a short break, and trust us, we've been working behind the scenes to bring you even more value.
It's wonderful to be back, William. It certainly has been a few weeks, and you're right, the economic landscape has not been quiet.
Right.
It feels like the perfect time to dive back in and connect the dots for our listeners.
I agree. Let's start with the headline news from this past week.
Okay.
On Wednesday, September 17th, the Federal Reserve made a significant move and cut its benchmark interest rate by 0.25%.
That's right. And this wasn't just any cut. It's the first one in nearly a year. The big question on everyone's mind is whether this is just a minor adjustment or, the opening act of a broader rate-cutting cycle.
Yeah.
The Fed's commentary certainly hints that more cuts could be on the horizon this year.
So, for our listeners, it's crucial to understand how this trickles down. Now, a Fed rate cut doesn't instantly lower your mortgage rate the next morning.
No.
But it absolutely sets the direction of the tide. For traditional or forward mortgages, lower rates are a clear win.
Right.
It simply makes borrowing money cheaper.
And when we look at reverse mortgages, specifically the home equity conversion mortgage, or HECM, lower rates are also generally very positive. Explanatory, the amount a retiree can borrow is calculated using what's called a principal limit factor, or PLF.
Okay.
This factor is heavily influenced by the expected interest rate. So to put it simply, when that expected rate goes down, the principal limit factor tends to go up.
Which translates directly into more available money for the borrower.
Exactly.
Whether they choose to take it as a lump sum or establish a line of credit.
If this truly is the beginning of a rate-cutting cycle, retirees exploring a reverse mortgage could find they qualify for significantly more funds than they would have just a few months ago. It's a key trend to watch.
But Sophia, as we always say, interest rates are only one side of the coin. The other, equally important side is the value of the home itself.
Right.
Which is deeply connected to the health of the overall economy. And the most recent employment data is giving us some real cause for pause.
That's an excellent point, William. The August jobs report was a genuine shock.
It was.
The U.S. economy added only 22,000 jobs, a number that fell far, far short of what economists were predicting.
And what's even more telling, I think, is this persistent pattern of downward revisions. The Bureau of Labor Statistics, they've been adjusting the figures from previous months, and it now appears the economy created nearly 1 million fewer jobs over the past year and a half than originally reported.
Wow.
So this isn't about one slow month.
No.
It's a trend suggesting the economy is cooling more rapidly than the initial headlines suggested.
So let's connect that back to the retiree in their living room. Why does a slowing job market matter if you're already retired?
Right.
It matters because a cooling economy almost always leads to a softening home market. If companies are hiring less, there's less income growth, less consumer confidence, and ultimately less demand for homes.
Right. It matters because a cooling economy almost always leads to a softening home market. If companies are hiring less, there's less income growth, less consumer confidence, and ultimately less demand for homes.
Exactly.
That can put the brakes on home appreciation or, in some areas, even trigger declines.
Precisely. For most retirees, their home equity isn't just a number on a page.
No.
It's the financial bedrock of their retirement plan. If the value of that asset starts to stagnate or worse, decrease, it fundamentally changes the retirement equation. This is the very dilemma we talk about. And it underscores why being informed isn't just helpful, it's essential.
And that core idea of being informed and empowered is the perfect bridge to what we've been working so diligently during our short break from the podcast.
I am so thrilled we can finally share this.
Yeah.
We have just launched a suite of brand new, completely free and anonymous calculators on our website, reversemortgagedilemma.com.
Our philosophy here was to solve a fundamental problem we hear about all the time. People want to understand their options, but they dread the idea of having to submit their personal info just to get a basic question answered, leading to a flood of sales calls they're not ready for.
These tools are designed to prevent that. The first one is a reverse mortgage qualification estimator. In just a few clicks, you can get a ballpark idea of what you might be eligible for based on your age, your home value, and any existing mortgage balance.
Okay.
All without entering a name or phone number.
Next, we built a voluntary payment simulator. A very common question is can I make payments on a reverse mortgage to keep the loan balance from growing too fast?
We hear that a lot.
This tool lets you see the powerful impact that even small voluntary payments can have on preserving your equity over time.
And tying directly back to our conversation about the economy, we created a home value decline impact tool.
Yeah.
You can stress test your situation. It helps you visualize what happens to your remaining home equity if property values in your area were to fall by, say, 5%, 10%, or more.
Wow.
It turns an abstract fear into a manageable variable.
Our entire goal here is to make these complex financial questions feel more approachable by putting the power to explore back in the hands of homeowners. No pressure, no sales pitches. Just clear answers.
And to make it even easier, starting with our very next episode, we're going to dedicate each show to one of these calculators. We'll walk through them using real-life, practical scenarios to show you exactly how they work and the kinds of insights you can gain.
We also want to invite our listeners to be part of this. If you have a specific situation or question you'd like us to analyze using one of the tools,
yeah, please do.
Please send it to us through the contact form on our website. We'd love to feature it.
In today's episode, we broke down the latest Fed rate cut and how it might impact mortgage rates and property values, especially for retirees thinking about a reverse mortgage.
Right.
We also touched on the softening job market and why it's so important to stay aware of its effect on home equity.
But most importantly, we shared something we've been quietly working on, a suite of free tools to help you understand your reverse mortgage options without any pressure.
So ask yourself, what would it feel like to explore your financial future from the comfort of your home on your terms?
And how much peace of mind could come from finally getting clarity around your retirement income strategy?
As we wrap up today's episode, remember, these market shifts and economic changes don't have to leave you in the dark.
Right.
We're here to help you stay informed every step of the way.
If you haven't already, head over to reversemortgagedilemma.com. Not only can you claim your free digital copy of the book, The Reverse Mortgage Dilemma, but you can now explore our brand new calculators under the Resources tab. They're free, require no personal info, and are designed to give you answers before you ever speak with a loan officer.
We're building these tools to help you understand things like, what do you qualify for? Can voluntary payments slow compounding interest? And what happens if property values drop?
And stay tuned. We'll be breaking down each of these tools in upcoming episodes with real-life scenarios to help you make smarter decisions.
If you're enjoying these short, insightful episodes, make sure to subscribe. And if you have a question you'd like answered on the pod, leave us a comment. We'd love to hear from you.
Until next time, be well, stay curious, and we'll see you soon.